Hello and welcome to IIFL Markets. I'm Sheetal Agarwal, and today we have with us Mr. S. Naren, ED and CIO of ICICI Prudential AMC. He's a veteran investor with over 2 decades of experience and has extensive knowledge of the equity markets. Welcome to IIFL Markets, Mr. Naren. It's a pleasure to interact with you today.
Welcome. It's a pleasure to be on your YouTube channel.
Thank you, sir. So, first off, what is your view on the markets right now?
See, I have been saying for quite some time that this is a bull market which has been created by the global central banks after March 2020. And they pumped in trillions of dollars into the economy. It's not that the economy was in trouble or something like that in the last 6 months. But then if you pump in trillions of dollars, you're going to have a big bull market. And the bull market will continue till the day the global central banks want the bull market to end. And so I believe that, you're going to have a big bull market till the day the global central banks want it. Till the central banks decide that the global central banks decide that the bull market has to end, then they'll end. Till that point of time, you're going to have a bull market, and they're pumping in record amount of money into the markets, and that is what is happening at this point of time. So every month, the U.S. Federal Reserve is buying $120 billion of securities at a time when the economy there is growing at 6%. So that $120 billion of securities and the US fiscal deficit is at its record. So the combination of the two results in a very positive stock markets across the world.
Right.
And that is what we are seeing at this point of time.
So how do you think, just to follow up to that, how do you think, we can better prepare ourselves as investors, even, mutual funds and other institutional investors as well, for any such scenario, that may happen in the future?
I think if you are, I've been a stockbroker from 1994 to 2004, and that's a big advantage for me when I do this channel. So I believe that, you have to be very disciplined, and you have to follow asset allocation principles. And if you are not disciplined or if you don't follow asset allocation principles, then I believe that it is during a bull market you will make money. But when something goes wrong, at that point of time, all the money you make will go away. I've had a situation where in 96 to 98 period, I was a stockbroker and I've seen a lot of investors lose a lot of money. And again in 2001 too, I've seen a lot of investors lose money in 2001 too. So I believe that if you are not disciplined and if you are not going to respect asset allocation, during the bull market, you will make a lot of money. In fact, much more money than you will make there if you are indisciplined. If you're indisciplined, you will make much more money in that bull market. But once the bull market ends, that indisciplined investor will lose so much money that all the money made will disappear. I saw that during the bull market, the indisciplined investor makes much more money.
Right.
In 94, 95, the indisciplined investor in 1994 made so much money, maybe 10 times more money than the disciplined investor. But in the bear market, which followed between 95 and 98, or similarly in 2000, 2001, the indisciplined investor lost 10 times the amount of money that the disciplined investor made.
Right. So how should, the retail investors approach these markets, according to you?
See, as a mutual fund, what we did was we actually created categories like, balanced advantage fund. We created categories like equity savings fund. In fact, in the fund of funds side, we created categories which invest in equity, debt, and gold like asset allocator fund. We did all this because we felt that, they should represent what a disciplined investor does. And this has been our experience that such investors are the people who make money in the very long run in a big way. So I think how does an investor stay disciplined? That is the challenge. And it's not
Yes.
easy because when your investor who's indisciplined is making money by taking exceptional leverage in 1994 or 99, how do you say, I will not take leverage? I will not do things on leverage. I will not take a big leverage. That is the challenge, if you ask me. And I tell people there are rules which I have found useful. I tell people start a notebook. In the modern day, start a Word file. In that Word file, if you don't write 10 lines before you do a trade, don't do the trade. So
Right.
if you can write 10 lines before you do a trade, then you do the trade, it is better than if you can do a trade automatically.
Right.
Is it a bureaucracy? It is a bureaucracy. But such principles will help you to slow down your decision making and help you to do better decisions. This is our learning.
Sure, sure. Interesting. Now, moving on to a little, macroeconomy. I mean, there have been rising coronavirus cases, and also vaccination has been rather slow. So, how do you think, the economic growth will be impacted? Because we've seen that the lockdown this time around was not nationwide; it was partial. So,
So as it is, you would have seen that the number of cases go away. So I don't think the October to December growth of the Indian economy is affected. I think the April to June economic growth is affected. So I don't think it is going to play such a big role. I don't think I'm so worried about that. And I think economic growth will bounce back from October to December. Since we did not have a perfect lockdown, we will not have a perfect recovery on the type that we had last year. So yes, if people think that they will have a recovery the way we had last year, we will not have it. But I think the economy is doing reasonably all right, particularly some parts of the economy. There are parts of the economy which never recovered, like for example, the travel industry, tourism industry. Some parts of the economy never recovered, and those economies have still not recovered, and they require possibly more push. But I would not so much worry about the long-term economic impact, because I think vaccination is going to happen in June, July, August. And I think normally monsoon is a slow period. So I believe that the October to December economic growth should be much more reasonable. So I don't think that is as big a worry.
So, like you alluded, travel, hospitality, these are the sectors which are worst hit from the pandemic, and have not recovered fully. But do you see any value there, one? And also, do you think that, some of the larger players can consolidate and maybe, strengthen their position further? What is your view?
Yes, but if you look at the larger players in these consolidated industries, actually they have not corrected at all. If you look at it, some of these stocks have not corrected at all, because people have recognized that the 3-year and 5-year view of these strong players in these industries has not deteriorated, and the markets have very, very carefully recognized that. And that is why I would say that while people know that the current quarter result will also be bad, and maybe the next quarter result will also be bad, the market has looked through them and said that the next 5-year outlook for some of these hotel companies or some of these airline companies continue to look very good. And that is how the market has been efficient.
Okay, so earning season is underway, and so what are your observations there, and what are your expectations for the coming fiscal?
Between 2013 to 20, we had a phenomenon which is globally called deflation, which means that many product prices did not go up. And in that period, you actually had poor earnings because of this phenomenon called deflation. In the recent period, we have had what is called as inflation. As you know, prices of aluminium, oil, steel, copper, zinc, soya bean, corn, sugar, all of them have gone up. In a period of inflation, actually earnings turn out to be pretty good. And it is only you as a consumer who get hurt, not the companies making these products.
Right.
So the companies making these products actually show good earnings, and you would see much better earnings in many of these sectors, even in the June quarter, despite the lockdown. Whereas in the period from 2013 to 20, what you gained as a consumer was only you gained. Whereas the companies making steel or aluminium or zinc or sugar, they all lost because their profits were down. So I think the outlook for earnings as such is far superior, because even the bad debt provisioning that had to be done in many areas have come down in the banking sector. If you look at brokerage stocks, they have done extremely well. Broking is doing extremely well. So many areas in the economy are actually doing much better. So I don't think there's a problem of earnings per se. And I don't think you're going to have that bad earnings the way people think. I think you're going to have good earnings because we are in an inflationary period. This period resembles the 2002 to 8 period, where certainly users of commodities, for example, some of the auto companies, and those kind of people are going to get hurt on earnings. But people will say, yes, this quarter there's a problem, next quarter there's a problem, but they'll eventually pass it on. And people will say 1 year from now, they'll be able to pass on the steel price and look through the problem of earnings. And that's why I don't think earnings is as big a problem at this point of time. Just like in the 2002 to 8 cycle, there used to be inflation and there used to be a problem of margins in many sectors, but it used to be ignored because people used to say it will look through. And the problem will disappear in 6 months, 9 months by passing on those prices.
Right. Understood. So I also want to understand, you have over 2 decades of experience in investing and you've seen a lot of cycles. So I want to understand, what are your key learnings that you would like to share with our viewers across this whole journey?
Well, the key learning, as you correctly said, is cycles. People don't recognize that there is something called cycles. And, at the top of the cycle, everything will look very good. And when things look very, very good, you have to be more cautious in equities. And when things look very, very bad, you have to be very, very positive on equities. And that is something which people don't realize, that actually people have to be much, much more careful at market when markets are very exuberant and are at all-time highs. And people have to be much, much more positive at market bottoms like March 2020. That is one key learning. The second learning, which I also don't know and ICICI Prudential also doesn't know, is how does a global central bank bull market end? Because this bull market has become very, very big because of US Fed and European Central Bank and Japanese Central Bank pumping $25,000 billion. I can't even write the number of zeros in them. How does this end? How is it going to end? I or ICICI Prudential Mutual Fund doesn't know that.
Right.
That is going to be a challenge. Of course, we came to a conclusion that the safest way for this kind of a market is to practice asset allocation, and therefore we looked at asset allocation products. But we also don't know how this bull market is going to end. That is going to be a very, very big challenge. But I think understanding cycles, recognizing cycles, being a disciplined investor, not getting caught in the themes of the day. And I would say that, having been a stockbroker for 10 years, being disciplined as an investor is so tough, because your neighbor is making money by being indisciplined. And that is the biggest challenge, if you ask me. And I've seen it all. And I left the broking industry for the mutual fund industry because of that reason, because I found it so difficult to convince many indisciplined investors that they have to be disciplined. So I said, let me become a mutual fund industry and create categories like balanced advantage fund and equity savings fund and fund of fund schemes like asset allocator fund of fund, because they themselves, those schemes themselves are disciplined. And that is what I realized over a period of time as the best way forward. Because I saw the bull markets like 1994, bull markets like 1999. They were very, very difficult. to convince investors to stay disciplined was so difficult.
Okay. So there has been of late, I've heard a lot of debate about whether valuation ratios such as price to earning, price to book are losing their relevance. I want to understand from you, what is your take on this?
There's a famous person called Sir Franklin Templeton. He said, when someone says this time is different, you have to worry. The statement that you just said, is equal to saying this time is different, that you can throw price to earnings out, price to book out, etc. And that's a worrying statement, because these are all models which have worked over a 50-60-year period, and they will work. Will they work over the next 1 year? I don't know, but it will definitely work over the next 5-6 years. 1 year back, people used to ask me, why do you have metal stocks in your portfolio? After all, metal stocks have never delivered. I used to tell them, show me a car without a metal stock. Show me a fan without a metal stock. Show me an air conditioner without a metal in it. But in the last 1 year, metals have just gone through the roof. So like that, what I believe is you have to be rational, and it is safer to believe in valuation models which depend on earnings. It is a rare investor and a rare company like Google and those kind of companies which have suddenly managed to transform their model and show that you can make earnings out of clicks. Every company has not managed to do that. True. And that's why I would say that it's much wiser to be invested in companies which generate cash flows, earnings, profits, and who have strong balance sheets. This is my learning of 32 years of being involved in financial services. But in narrow periods of time like 1999, when eyeballs prevailed, in 2007 when land bank prevailed, I would say it looked like these techniques were not relevant. But in the long run, over periods like 3 to 5 years, they have always come back. And one of the reasons, as one person said, there are old investors, there are bold investors, there are no old, bold investors. It comes out of this principle.
Right. Interesting. So now I want to understand, what are the themes and sectors that you are bullish on?
I'm bullish on one theme, be disciplined. Second theme I'm bullish on is that follow asset allocation.
Right.
Third is that I believe that, the risks are going to come out of US central bank and other global central banks. As and when that theme plays out, and there is an opportunity which comes out of that, you should look to invest aggressively. And fourth is trust old valuation methodologies like dividend yield, cash flow, free cash flow, operating cash flow, low price to earnings, low price to book, good balance sheets, these kind of things. These are the themes I believe in.
And sectors, would you like to share some sectors that you like right now?
So any sectors which follow these things, which as you know, involves things like, some oil and gas, telecom, if you look at the future, utilities, certain corporate banks. These are some of the sectors which actually meet some of these requirements at this point of time. So these are the sectors I like at this point of time. Till recently, I would have actually said metals, because metals also fit that bill a lot. But metals is the only, in this basket, only metals has delivered. The remaining are yet to deliver. So I have removed metals from this basket and kept all the others in it.
And would you prefer companies which are focused on the domestic economy for their growth, which are more outward looking, in the sense pharma, IT, those sectors are more export dependent. So how would you, decide now?
No, I should have added pharma and IT for defensive investing. I think pharma and IT are two sectors to look for defensive investing at this point of time. But I think globally oriented companies are better in the near term. And defensive long-term investing can be done by investing in domestic companies which are reasonably valued. But many domestic companies which are defensive are not reasonably valued at this point of time. And that is a challenge for us at this stage. Having said that, if you're disciplined, you stick to asset allocation, opportunities present itself once in 2-3 years. Like, last year, March 2020 was a beautiful time to buy. If anyone gathered the guts to buy, the kind of returns that they made was unimaginable. Similarly, just the period after Demon was one such opportunities presented in 2013. So my view is once in 2-3 years, you get a good opportunity to put big money to work. And during other periods of time, if you're disciplined by following asset allocation, it helps.
Okay. So, I want to understand there are a lot of new investors, there has been increased interest in equity investing and capital markets in general. So, according to you, what strategy should they adopt? How should they approach markets to create wealth for themselves?
First, they should learn to be disciplined, as I told you. That's point number one. Second is they should consider mutual fund products as a method in the first 2 to 3 years. I would actually tell them that for the first investing cycle till the first bear market in equities, if they use mutual funds, they would possibly be better off because they will understand what can go wrong. Then in the second cycle, they should do direct equities in a big way so that they know what all happens, what all mistakes even experienced people make. Forget inexperienced people. And third is completely avoid leverage.
Right.
That is third. Then going into smaller and smaller companies is riskier. Then fourth is avoiding companies which don't have profits is the most risky. Avoiding companies which don't have a long-term history is worthwhile. These are some of the principles which I have seen work for me. You're taking me to my days as a stockbroker.
Okay. So, sir, I want to understand now we've seen that ESG investments are gaining momentum across the world. And there are in India a lot of schemes which are dedicated to ESG investments, right? But do you think that over a longer period of time, these would become an inevitable part of investment decisions, the ESG considerations, ESG parameters, and not limited to certain schemes which are focused on it? I mean, how do you see this really shaping up in the future?
I think without ESG maybe as a continent or as a country, we won't exist 100 years from now. And in my opinion, in the 32 years that I've been in financial services, if I did not look at governance, I would have invested in the wrong companies and then I would not have remained as a CIO. So the fact is that governance is a very important role to play. And again, it's the companies which have good governance, which have good social practices as well. And on environment, things have changed a lot. And what was acceptable, let's say in 80s when I was studying engineering, and what is acceptable today has changed a lot. And things like that will keep improving. And what is acceptable now will not be acceptable 10 years from now. And I think ESG is a structural development, but how each company, how the world, how investors see ESG will also change over a period of time. And I believe technologies will also be required because over a period of time, we all know that, what all is required. Frankly, if you ask me, we all need to consume less energy, which means that at some stage, why is it that we think that oil is more acceptable? Because oil is also energy.
Yes.
So these kind of questions will also come up. And there are 25 questions like that come into being when you start looking at ESG. But in my opinion, without looking at ESG, you could not have delivered returns in any fund, in any mutual fund scheme in the last 17 years that I worked in ICICI Prudential. And I believe that ICICI Prudential, whether formally or informally, I have always been looking at G, S, and E. And what is G, what is S, and what is E is changing every year.
Okay, on the overall markets and overall sentiment, what is the key downside risks that investors should watch out for? Of course, you've mentioned some of them earlier, but are there any more risks that one should watch out for?
I don't think Indian investors are over-invested in equity. I don't think Indian business cycle is advanced. The credit growth has not happened. Capex cycle hasn't happened. We have not had, the corporates are not over-leveraged. I don't think the Indian rich are over-leveraged. So I don't see any such problem. So I believe that the risks are going to come from a overextended global cycle because of the central banks pumping in money. Other than that, there can be events which happen, which you and I can never predict. Did I predict COVID-1? No. Did I predict COVID-2? No. So there are a lot of imponderables which we all think we can predict. On March 1, if we had done this session, I would have never told you that COVID-2 is going to come like this. So I'm just saying that there are things which can happen. But if you're asking me, known is the risk of central bank tightening. Right. There are unknown which you and I don't know. That can always happen. And all this can be solved through discipline, can be solved through asset allocation categories, it can be solved through careful investing. And once market valuations become cheap, at that point of time, investing more aggressive.
Any good books on investing that you would like to recommend?
See, my gurus are Howard Marks, Michael Mauboussin, James Montier, and Dr. Atul Gawande. And for people who want to read on the net something every week, I think Morgan Housel on collaborativefund.blog writes so much every week. He writes a small 4-5 pager worth reading. So these are some of the people whom I would recommend people to read. The reason I recommend global people is that they don't get biased by Indian. They don't tell you buy this stock, buy that stock. So you read their theory and implement that theory locally. You will get the best benefit.
Okay. Thank you so much for joining us and giving us this. Thank you so much, Mr. Naren.
Thank you. Thank you.
Thank you. Stay tuned to IIFL Markets for similar videos.